Welcome to Module 19, our discussion of capital. So we have been going through the bank balance sheet. Here's Abacus Federal Savings Bank and the FDIC information. And so we talked about assets, and then we talked about liabilities. And as those of you with a more finance background know, the liabilities plus the capital equals the assets. So now we're down to the capital on the bank balance sheet. And this is a pretty basic bank, so it has a pretty easy capital situation, but a larger institution like Chase would have a much more complicated situation. But this still gives you a basic idea of kind of the categories that we've talked about. Get to PowerPoint. In our discussion of capital and in your reading, hopefully you saw that the capital is really a key measure of the safety and soundness of the institution, and one of the things that the regulator is going to monitor quite carefully. And that's because it really gives the regulator a good sense of how much of a downturn a bank can withstand. And as we've seen throughout history, downturns come when they are least expected. And so there's always sort of, I don't know, a debate or different views on what's an appropriate level of capital. And I hope that the reading really kind of gave you a sense of how there are different views and how the view changes over time. And sometimes when times are good, holding a lot of capital seems like a wasteful thing to do. But when we go through a downturn, if capital levels are low, the consequences are much worse. So our first case was the First National Bank of Bel-Air versus the OCC. And this was a significant case because the OCC determined this bank had inadequate capital. It looked at its books and it ordered the bank to raise its equity capital to the total assets. And this was called the leverage ratio, which was the only ratio the OCC or any of the regulators were looking at. It's a very basic ratio, equity over assets. And the bank did not believe that it had inadequate capital, and so it failed to comply. And the OCC said that the bank was operating in an unsafe and unsound manner, and the bank challenged that determination. And so they go to court, and the OCC presents its evidence and says that this bank was at the bottom of its peer group. And the bank presents its own experts that say, well, it may be at the bottom, but that doesn't mean it's bad, and that it's doing quite well in its earnings and some of the other measures of financial health. And so after all of this testimony, the court ultimately sides with the bank. And this was considered very problematic. If a bank could get its own expert to challenge the bank regulator, it would really diminish the power of the regulator. And so that same year, the United States Congress adopted the International Lending Supervision Act. And if you read these provisions out of the act, which still exists today, what you see is that the bank regulators are given by statute the authority to determine the appropriate level of capital. And they are expressly given discretion to deem what is necessary and appropriate. And they are also expressly given discretion to determine when the level of capital constitutes an unsafe and unsound practice. And so once this was adopted, as we saw in our next case, when the FDIC, another bank regulator, issued a capital directive, which is what it's called today, and told this bank that they needed to raise their capital. And by 1991, there are actually two ratios, a primary ratio and a total ratio, which one used only the better equity and the other used all the equity over the assets. It said that those ratios both needed to come up, and when in fact they didn't, and there was a challenge by the bank, the court said, well, the FDIC followed the law. They issued a capital directive after using their discretion and their best efforts to determine what was appropriate. And the bank failed to comply, and they failed to follow the procedure that the FDIC has set up for contesting this. And so it really illustrates that once that law was changed in 1983, the courts are really going to uphold any kind of capital plan that the regulators come up with, provided they follow, the Administrative Procedures Act and the requirements of how they present their plan. And so that's really the situation that we continue to be in today, because there really is the belief that although you can set measures, and we'll see there are a variety of measures, ultimately, there has to be some discretion, and there is in our current system. As I mentioned, the leverage ratio is the traditional US measure. It's where you just basically put the tier 1 capital, which is sort of the regular capital, I like to say, over the assets, and you get a ratio here. If you put, 4 over 100, you get a 4% ratio. And this was the measure that was used by the United States in, well into the 80s. But if you think about it, and if you know much about, equity and liabilities and putting things in a balance sheet, you'll realize that it's a lot more complicated. Let's just say this is really a simplistic measure, and particularly, it's simplistic for Abacus, but if you think of an institution like Chase, it's really an incredibly simplistic method. And so in 1988, the United States, along with other countries, met in Switzerland and Basel, and they came up with an international system for measuring capital. And this is discussed in your book on page 564. And part of what they did was they acknowledged that not all capital is the same, and that these needed to be kind of treated differently. And they came up with these different categories. They also came up with different categories for the assets. And they ultimately came up with 3 different ratios. They kept the leverage ratio, but they had one ratio, which was the tier 1 capital over the risk-weighted assets. And they had a second ratio, which was the total capital over the risk-weighted assets. And in your book, you see the different categories, but we'll talk about them more when we get to the current system, which is Basel III, because Basel I is no longer being used. But the thing to know is that Basel I was a better system, and it moved us toward the system that we now have. But it was also clearly still not sophisticated enough. It was not as simplistic as just the simple leverage ratio system, but still not really reflecting interest rate exposure, liquidity, concentration, effectiveness of management, quality of assets, even though there were 4 categories for the assets. Clearly, there's really far more sophistication. And so it was very quickly decided that Basel I needed to be improved. And so everyone got together, and we also were in a time where the economy, the world economy, the US economy was quite good. And it was decided that Basel I was requiring too high of capital levels. What's interesting is that every time these accords are adopted internationally, the US is the last to adopt them, because we have a complicated system of government. They have to go through Congress, then the right rules have to be adopted, and we always want to put our own stamp on them. So whereas some countries just can take them back from the meetings and put them in place, it takes a long time. And so in the US, we were just beginning to sort of roll out the implementation, because there were real concerns that Basel II had some of these characteristics that I talked about, like looking more at management and things like that. But it definitely was going to reduce capital, at least for some institutions. And so we were just starting to implement it. And the larger institutions were being required to sort of roll it out kind of used the new and the old system to see what the changes would be. When we had the financial crisis in 2008, which sort of halted Basel II, which was going to lower capital. And we really went right to Basel III, which came out of the financial crisis, which although it happened in the United States, it also happened internationally. And everyone then decided that Basel II, with its lower levels of capital, and giving more discretion to the large financial institutions, maybe wasn't so great. So we're going to kind of jump ahead and not spend so much time on Basel I, on Basel II, and go right to Basel III, which is on page 574. So we change direction and decide that really lower levels of capital, bad idea, higher levels of capital, good idea. And that is somewhat where we are today, although now there is some discussion that maybe they're too high. The international community added the leverage ratio. We in the United States always use the leverage ratio, but the international community did not until Basel III. We also created new, stricter measures of capital and stricter measures and more varied measures of assets. And we added liquidity. Depending on the size of the institution, all institutions needed sufficient capital for 1 month, and other larger institutions have very strict stress testing, which you might be familiar with because it is reported on the news, or at least the financial news. Basel II raised the ratio. So if you had looked in your book, there's the table under Basel I, and then on page it's now 575, I believe it is, there is the Basel III table. So essentially it raised the Tier 1 capital ratio over the risk-weighted assets from 4 to 6. It created a new ratio, which was even better than Tier 1. It was the equity capital ratio over the risk-weighted assets, had the total ratio, and then the leverage ratio. And so to give you just a brief idea, and as you can imagine, this is where a lot of the accounting comes in, deciding where the capital is. So the Tier 1, I like to think of, is kind of the regular capital, the common stockholders' equity and retained earnings. Additional Tier 1, which isn't in the common equity, which is the very best, is the non-cumulative perpetual preferred stock and surplus. And the Tier 2 is allowances for loan losses and subordinated debts. And then certain types of what is traditionally considered capital, which is goodwill, is then deducted. And so I've put up some definitions here to give you an idea of what these are. And this is really just to give you a sense of, obviously, these are some pretty complex determinations that had to be made by the bank that then have some significant ramifications. Besides creating a new ratio, which is the equity, the capital, the big part was making the risk-weighted assets far more sophisticated. Under Basel I, there were only 4 categories, and one was basically 100%, which was the old category. Under Basel III, it can be anywhere from 0 to 150%, which basically was acknowledging that some assets are really quite risky, such as high volatility commercial real estate and past due loans. So that was a lot of what led to some of the problems in 2008. So that was on everyone's mind. Another part of the problem in 2008 related to residential mortgages, which under the old system were always given a 50% ratio. And so now the residential mortgages can be 50 or 100%. And in fact, they only get the 50 if they are performing, which means they are paying on time. And there is an entire chart on page 277 of your book. But to kind of summarize it, we have some 0% multipliers that are given for assets that have no risk, such as, U.S. government securities, cash, things like that. We have the 20% is to the Fannie Mae and Freddie Mac equities. Those are typically the mortgage-backed securities that are created by Fannie Mae and Freddie Mac, kind of interesting since they did run into problems in 2008, but they continue to get the 20% risk-weighted multiplier. Certain public sector equities, things from state governments, can get the 20% as well. Most corporate equity exposures at 100%. As I mentioned, the residential mortgages can be 50 or 100. And then the high volatility commercial real estate exposure gets 100 for 50%, as well as any kinds of mortgages or other loans that are past 90 days. There are then, as I mentioned, these 4 different ratios that are then calculated using the leverage ratio uses us traditional assets, but all of the others use the risk-weighted assets, and then the 3 different measurements of capital. And then you come up with these different ratios that are then kind of put into this table. And the full table is also in your book. Well, what this illustrates is that, first of all, you have to make all these determinations. And if you think about it, these assets can be going up and down in value, and things can move from category if they are, say a mortgage that's paying on time and then it goes into serious default. So, this is a constant calculation. But ultimately, you would do these different ratios and you are given a capital category. And so each bank has a capital category. Needless to say, and as we'll talk about this in the coming weeks with the bank supervision, there is a 5th, which is not on this slide, which is the critically undercapitalized. That is, hopefully no one even ever gets there. The bank regulator should really step in before that happens. But always well capitalized or adequately capitalized are really the only places a bank should be. And really well capitalized is where the bank needs to be, for example, if it wants to be a financial holding company. It will also impact a bank's assessments, because this will impact its risk profile, and it will also impact the frequency of examinations. So if you're not in the best capital category, you will be examined more frequently, particularly if you're a small institution. You may be able to go much longer. If you're a large institution, you're probably continually examined. But I think the key for all of us on a compliance side is that the capital is watched closely by a regulator, and it's going to really impact the level of supervision and oversight that a bank is going to get from its regulator. And so it really does tie in to compliance, because it's very much related to how the bank is perceived by the regulator. So we are now under Basel III, which definitely increased capital and came about from the financial crisis that occurred internationally around 2008. But needless to say, it is an evolving topic. There are those who say that the current system requires too much capital. There are those who still think that more capital should be needed, and they would point to the large failures in 2023. There are those who say the system is too complex. That would be the smaller institutions. They think it's very complicated, and they would be right. But there are also those critics who say it's too easy to manipulate, and that may be true too, particularly for a large institution. There are advanced approach rules and additional requirements for the largest institutions. Like I said, the stress testing, which, really tests whether different economic scenarios will, cause a bank to go under, or whether a bank has sufficient capital and liquidity to withstand certain types of economic scenarios that the regulators come up with. But it is definitely an evolving topic. And so, I think we can know that it will never stay, the same. But we are certainly in a more sophisticated capital regulatory system than we've ever had in the United States for banks. So we will continue to talk about some of the supervision that flows from these capital categories. And I welcome your questions. Thank you.